Morning, and thank you for joining us for the first webinar in our HTG Financial Fitness for Women series. My name is Carrie Connell, and I'd like to introduce you to my colleague, Allison Donaldson.
Hello. Carrie and I have both been advisors at HTG for 8 years, but our firm's been around a lot longer than that, almost 30 years, and we've been helping families nationwide plan and invest for their futures. Today, we help over 300 families work towards their financial goals. And this picture on the screen that we're sharing shows you that we're not the typical financial advisory firm. 12 of 13 of us here at HTG are women, and this is in very stark contrast to the industry average, where about a quarter of advisors are women. And one of the most rewarding aspects of our job is fulfilling HTG's mission of financial education. We know many women are taking on more and more of a role in terms of managing family finances, whether that's daily household finances, long-term savings, investing, caring for older parents. And in a minute, we'll explore some statistics that say women are less confident than men when it comes to finances, and we're on a mission to change that. So today we're going to start by outlining a roadmap for the entire webinar series, and then dive into the topic of the day, which is building a solid foundation. We would like this to be interactive as possible. While Carrie's presenting the content for today, I'll be fielding questions through the chat feature, which is in the bottom center of your screen. And that chat will be anonymous. Only Carrie and I will be able to see it. So don't be shy. Definitely put your questions in there, and we'll try to get to them as we move along through the content. And with that, I'm going to kick it back over to Carrie to get started.
All right. As you know, this is a 5-week webinar series. Each week, we're going to be delving into a different topic. Please join us for one or all of the webinars in the series. All the webinars are going to be recorded, and anyone who's registered for the webinar series will receive a copy of the recording. And I think you'll be able to forward it on to someone if you know somebody who might be interested as well. So no one likes to talk about money. It's taboo, it's uncomfortable. Honestly, the only time you ever hear people talking about money is when they tell you about how much money they made on a particular stock. And they never tell you how much money they lost on another stock. And I understand personal finance might not be a priority for you, and you've got limited time, you're juggling multiple balls in the air, and you may not even consider it fun. But the more prepared you are, the more control you're going to have when unforeseen events occur and transitions in life occur. Events such as divorce, job loss or change, relocation, extended medical illnesses. I mean, people saw that in the last couple of years with COVID. Those were very unexpected illnesses that people had, or the loss of a partner. And as you know, on average, women in the US live 5 years more than men in terms of longevity. So it's important for women to understand personal finance. I'll use the example of my mother-in-law, who sadly lost her husband in her 70s. And she had never had any involvement in the family finances. She had never actually even written a check or paid a bill. And to have to face that when you're dealing with the loss of a loved one and trying to understand all this new information was really daunting for her. So getting prepared in advance, I think, is really important. And, also women are not only bearing primary responsibility for child rearing, but also for caring for parents. Many of us are part of the sandwich generation and find ourselves supporting not only the generations before but after ours, but also before. And you may need to step in and help your parents with their finances for a variety of reasons. It could be, a loss of one of the parents. It could be memory issues, or it could be as people age, they get less interested in dealing with finance and understanding and keeping abreast of what's going on. And you may need to help a parent with their personal finances, and so they can spend time on things that they find more important. This webinar, we don't anticipate, is going to answer all of your questions. Every person has a unique financial situation, and we have basically 3 goals for this webinar series. 1 is to educate, 2 is to empower, and 3 is to motivate you. So just talk about education for a minute. Last year, Fidelity did a study on women investing, and 62% of women surveyed indicated an interest in learning more about financial planning and investing. So our first goal is to educate this group on several financial planning topics. I'm a recovering attorney, and as an attorney, you learn how to issue spot. So we're going to present you with a number of different financial planning topics and ideas, and we're giving you the opportunity to issue spot and identify topics and ideas about which you want to learn more. And we're not going to be able to answer all your questions, but we're at least going to give you a nudge to learn more about certain things. This webinar series is focused on women because studies have identified a basic lack of understanding of financial concepts among adults generally on a global level, but they've also identified that there's an 8 to 10% gap between the financial knowledge of men versus women. So we really wanted to focus on women for that reason. And the other thing to consider is that you may say, oh, you know, my partner or another family member manages the family finances. And that's really normal to have a division of responsibility among different family members. One partner may pay bills, one may handle home renovations, one may handle kids, etc. But even if one of the partners is taking the lead on family finances, it's really important for the other partner to understand the basics and know how to access key documents and accounts in the event of any event, I should say. So our second goal is sort of to empower women, give them more confidence about finances. The same Fidelity study saw that 68% of women responding that they feel confident managing the household and everything that goes on in a household, but only 31% feel confident about planning for retirement needs. And in fact, only 23% of women globally take control of the financial planning decisions for their families. And this percentage in the survey actually was lower for millennial and younger women. So why don't more women take control of their family finances? Many women cite this sort of imposter syndrome feeling. They feel insecure, they doubt their knowledge and their ability to make financial decisions. And this insecurity leads to stress and anxiety. So one solution is to learn more. Knowledge is power, and also to talk about personal finance with friends and family, break the taboo, so to speak. And I will say, if you are in a partnership, if only one spouse or family member is in charge of making all of the financial decisions, it can be really stressful and create a lot of anxiety. So it really helps in any situation, whether you're in a partnership or you're a solo person, to have a sounding board for making financial decisions, whether it's a partner or a family or a friend. Find somebody that you can talk to when you're making decisions. And if you are in a relationship, having a basic understanding of finance really empowers both of you and avoids any misunderstanding between the two of you. And our third and final goal is really to motivate you to take action. A lot of us get really energized, I'm the worst about this, to tackle a new goal, such as like learning a new language or updating your estate plan. And we get bogged down in the details and we don't follow through and finish the goal or the task. So we want to talk, and we also want to encourage you to talk about your financial concerns with your partner, your family, your friends. And if you have questions on a particular topic, dig in, do some research, and learn more about the subject. And that will help you feel more comfortable. And finally, we want to help you identify the steps needed in to get your financial plan in order. We want to help you get organized and gather information on your current financial situation, identify and set clear goals for the future, financial goals for the future, and develop a plan and implement it. So let's get started. Your goal right now is to take a snapshot of where you are financially. And this requires gathering information and getting organized. And this is probably the biggest stumbling block because, you know, you start to collect information, you make a phone call, you ask somebody for a copy of an insurance policy, you can't get somebody on the phone, you know, they say they're going to drop it in the mail, which causes a delay. Don't get derailed because you can't find the information readily and quickly. Just set small, manageable goals for yourself for collecting information, and then follow up. So if you send a call and look for a particular account statement or an insurance policy or some other information and you don't get a response, create a calendar item and say, I'm going to follow up with this person in a week if I haven't gotten a response. And I think it's really important that you also ask questions. So all of these, whether it's your financial institutions, whether it's your insurance agents, these people are there to help you. They have people, a whole dedicated customer service staff to help answer questions. So don't feel bad about calling and saying, I got a copy of my insurance policy. I don't understand how to read it. Could you help me go through the statement? They're there for you for a reason. So ask questions. So the first thing you want to do is start by gathering all this information about your assets and your liabilities. And the goal is to create a balance sheet or a net worth statement. And this is basically, a net worth statement is basically taking your assets minus your liabilities to kind of understand what your net worth is. So in terms of assets, what are we talking about? We're talking about bank accounts. We're talking about investment accounts, retirement accounts. Your home is considered an asset if you own. Other property that you might own that has significant value, whether it be art or jewelry, cars, if you own your cars, kind of figure out what each asset is, figure out what type of asset it is and who owns it if you have multiple family members, who owns the asset, how much it's worth. And this process is actually really good because a lot of people have accounts all over the place. They may have 401k statements or retirement plans from former employers that they've sort of left with former employers. They may have accounts that they've inherited. You might have multiple brokerage accounts at different institutions. So kind of getting all that information in one place, although it takes time, can be really helpful and informative. The next thing you want to understand is what kind of liabilities you have, what kind of debt you have, because it's really important to understand what you owe. And so that might include things like mortgage, credit card debt, car loan debt, student loan debts, both for you or for your children, and kind of collecting all that information so that you have it readily available. And then you want to sort of focus, next step, of course, would be kind of to focus on managing your debt. You might have been reading, the paper, that in the last couple of years, we've had record low interest rates, and they've been great years to refinance your mortgage. So taking a look at what your mortgage rate is today and understanding it will be really informative in terms of looking at where rates are. They're starting to climb, but you never know if your rate is higher than the current rate. And if you have credit card debt, you need to start understanding what kind of interest rates you're paying on that debt and trying to to help you prioritize how to repay it. And student loan debt, both your loans or those of your children, it can be really complicated. So understanding what the different interest rates are and what the terms are. Some student loan operations give you credit if you start paying on a regular basis. They may lead to lower interest rates. So getting all that information together on your assets and liabilities is the next step. So what do we do with that information? What we want to do is create a net worth statement or a personal balance sheet. And you might have seen this, like if you ever served on a board of a nonprofit or if you owned a business, you'll often see the entity's balance sheet. Basically, on the left side, you list all of the assets that you or the entity owns. So in this case, you've got your taxable account, your savings account on the left side. You've got retirement accounts. And you've got your home, and if you own a home or a second home, and then personal assets that have real value, I guess you would list them on here. And then on the right side, you have your liabilities, and you're looking at short-term liabilities and long-term liabilities. And what you're basically doing is you're saying, here are all my assets, here are all my liabilities. Do my assets exceed my liabilities? And that's going to be what my sort of net worth is. And net worth is a good indicator of where you are financially today. And when we talk about sort of savings and creating goals for retirement and other goals in subsequent webinars, this information is going to be really informative. But this is kind of just the starting point, the balance sheet. You can't view it in a vacuum because you need to understand where you're headed. So in other words, if you have all these great assets now, but you're spending down your assets, you're going to be in a different position than if you're growing your assets. So next, we're going to look at what your cash flow is and whether you're spending down your assets or building your assets. And to do that, we're going to first collect all the information about your income.
I'll just interrupt 1 second. We got a great suggestion from one of our participants that what she does is create a notebook or a folder with all of this information. And as it gets updated, she sticks it in there, which I think is a great way to be organized.
That's great. That's great. Because this isn't something you do it's not a one and done type thing. This is something you want to look at on a regular basis. So having all the information, once you gather all the information, it's very easy to update it over time. It's that initial sort of gathering information that can take a lot of time and be a little frustrating.
Exactly.
So basically you want to understand what your income is that's coming into your coffers and how much is going out to cover expenses and obligations. And obviously, if you have more coming in than going out, then you're likely saving, or at least you have the ability to save. And so we're not going to go into all the different types of income here, but just sort of point out a few. One is sort of pensions. Pension is an investment fund that the employer contributes to during your employment years and which typically pay out during retirement. And you might not have a pension, and that would be kind of the norm for today because employers have been shifting the responsibility for retirement savings to employees by offering more 401k plans and matching contributions to 401k plans rather than pensions. But it's something you should investigate to see if maybe you have a pension from a prior employer. Another thing to think about is Social Security. As you know, Social Security is a federal program that provides income to retired, disabled, and widowed persons based on their earning record. And in order to be eligible for any type of Social Security benefit, you basically have to have earned 40 credits, or basically quarters, annual quarters of work, or 10 years. So it's not a high bar. And you might also qualify for a benefit if you never worked and you were married for at least 10 years. You might be able to claim credit on your spouse or your ex-spouse's record. But it's really important to kind of see where you are and what kind of benefit you might be entitled to. And so I'd encourage everyone to go onto the Social Security Administration's website and create an account. And there's a couple of reasons why you want to do this. One, if you create an account and create a username and password, it prevents someone else coming in and fraudulently creating a username and password and trying to use your earnings benefit. But secondly, it's good to understand how many credits you might have. And as I said, it only requires 40 credits to have any type of Social Security benefit. And you might find out that you have 35 credits, and it might make sense to work for another year and a half or to work, get a part-time job for a year and a half to sort of make sure that you meet the eligibility requirements for Social Security. And in fact, Social Security and Medicare are related. If you qualify for Social Security benefits, it means that you don't pay a premium on one part of Medicare, which is Part A. And you're still eligible for Medicare, even if you don't have a Social Security benefit, but you may be required to pay premiums for that healthcare coverage. So it's a good thing to look and see what's out there and understand what your Social Security benefit might be. So after you've collected all of your income, we get to the fun part. You need to understand what your spending is. So I'm going to put the spending or expenses in 3 buckets. One is, fixed expenses. These are the expenses that are the same month after month, year after year. If you own a home, you have a mortgage, it's that mortgage payment, monthly mortgage payment, or if you're renting, it's your rent payment, your real estate taxes, etc. The fact that you need to turn the lights on in your house, that's kind of a fixed expense. And then there's the variable expenses, clothing, home maintenance. So home maintenance is probably the biggest expense that people don't really understand or pay attention to. If you own a home, you need to maintain it or it's going to lose value. So you need to factor that into your expenses on an annual basis. And then there's the discretionary expenses, eating out, vacation, entertainment, gifts, etc. And this can be like a really daunting process for people. First, they may not want to look at their spending, which I totally understand. And it might be difficult to kind of track your expenses. So there are a couple different software solutions to this, things like Mint, Quicken, You Need a Budget. All of these software programs will help you track your expenses for a period of time and create a budget. Or, you can pull the annual reports from your credit card statements. The credit card companies all offer these annual reports, and they'll try to help you identify or categorize your expenses over the course of a year. There's different ways to look for the information. And, you may say, tracking my spending is budgeting, and budgeting is a dirty word, and I don't want to get involved in it. But really, understanding your spending is really key to understanding whether or not you're spending money on things that you value and that are aligned with your goals. And I'll use my own personal example. There were a few years there when we graduated, my husband and I graduated from college, where we were, living hand to mouth, and, we were living on a very fixed budget. So I knew exactly where all my money went. And then as we progressed in our careers, we had a little bit more leeway, and we had kids, and we weren't focusing on how our spending was, where our spending was going to. And so we started tracking our spending, and probably not a big surprise, but the surprise was how much we were spending annually on restaurants. And that was something we really enjoyed, going out with our kids. We would bring cards, we play cards at the different restaurants while we're waiting for our food and chat with the kids. But the amount of money that we were spending was more than we anticipated. And we decided that we valued travel more than eating out. And so we kind of gradually shifted our spending towards travel and eating at home more often. And we all had to become better cooks. And as a result, my son is an exceptional cook. And he went during COVID, like he cooked every night for us. He was on the cooking apps, etc. My daughter, she's kind of, helpless. But, this is something that we identified as a way that we wanted to shift our spending, and I don't think we ever would have realized it unless we actually saw the number and had a discussion about why we didn't want to spend that much money on restaurants. So understanding your spending really kind of, in some ways, can give you more freedom to spend freely, because if you know that you're spending on something that is important to you, you may be able to do it a little bit with a little bit less guilt, for example. And for others, looking at your spending may reinforce whether or not you want to cut back on spending in certain areas so that you can spend more on another goal or in retirement.
So Carrie, some of these expenses are lumpy. They come in waves, like home maintenance, for example. 1 year you might have to replace an air conditioning compressor. Another year you might only have moderate expenses. How would you suggest handling that when creating a spending plan?
That's a good point, because no one anticipates or knows when you're going to have to replace your roof or something where there's going to be a budget item. There's a couple ways to look at it. You can get into the nitty gritty and say, I expect that every 10 years I'm going to need to replace the air conditioning unit, put a value on it, and spread it over 10 years. And a lot of people say, in general, we can anticipate that we're going to spend between 1 and 2% of the home value each year on maintenance. And so we'll sort of set that amount aside. So I think it's a little bit of a balancing act. And it also depends on how much money you want to put into your house. Some people are trying to maintain a certain level, and other people are trying to improve a property. But 1 to 2% of the house value is a typical amount to start with.
It's good guideline.
So now you've got your income, your cash inflows, and your cash outflows. And so basically, we're going to use this information to create what we call a cash flow statement. It's basically income minus expenses, and it tells you whether or not you're living within your means. And it can help you understand whether or not you're spending down those assets that were on your balance sheet, or whether you're adding asset values to your balance sheet. This is just you put all the information together. It may not be perfect at first, but it's a good exercise to make sure that you really understand what your expenses are. Because if you see that the net cash flow is positive for looking at a particular year, and you don't see that cash accumulating in your bank account, then you've probably underestimated your income or your expenses. And usually it's your expenses. So take another look and make sure that you really understand where your money is going. Looking at your cash flow statement can really raise a lot of questions for your family. Experts suggest that you really envision what you want in retirement, which is really hard to do especially at a younger age. And also to understand sort of how much that lifestyle is going to cost. But it's a good exercise, and it will make you ask the question whether or not you're willing to spend less today to ensure that you have that lifestyle in a retirement, or whether you need to. You may not need to.
We have a couple of points being brought up. One, certainly if expenses are greater than your inflows, one idea is to look at opportunities to refinance, especially when rates are currently relatively low, and also to reassess your insurance needs. So you may have the opportunity to reduce insurance costs by revisiting your coverage. And then one great question is, when looking at the cash flow, how do you factor in taxes? And I guess maybe that depends on what stage of life you're in.
Yeah, that's a big question. Looking at your taxes, you really have to understand your income and how it's taxed to understand your annual tax obligations, and how much wiggle room you have in reducing that tax. And I will be the first person to admit that I still use TurboTax for my taxes. But this is a situation where a tax accountant can really add value, and a tax accountant in particular that's doing tax planning for you, looking for ways to reduce your taxable income, so that your cash flow is more positive at the end of the day. But everyone has to pay taxes, so it's part and parcel of the experience. So, I mean, one way you can do is just start by looking at your income and looking at the tax rates. We're not really going to delve into taxes on this webinar series, but the way that the personal income tax works is that there are brackets. So your first, let's say $12,000 of income are taxed at a low rate. And there are brackets that build on top. And as your income grows, that proportion of your income is taxed at greater and greater rates. It's a progressive income tax system that we have. So I think you need to one way to look back at your tax return from the year prior. And if your income is similar, you can extract what type of tax liability you might have for that year. I don't know, Allison, if you have any other suggestions.
I think it depends to what kind of income you have. So let's say you're in retirement, you're taking required minimum distributions. We often recommend that someone withholds their income tax from their distribution. So whether you're receiving that on an annual basis or a monthly basis, as if you're paying yourself, we find it's very helpful to withhold taxes rather than having it catch up with you at the end. Conversely, if most of your income is investment income, you're going to want to make sure to be paying estimated taxes along the way, quarterly estimated taxes.
Okay, so now that you've created your balance sheet and your cash flow statement for your family, it isn't a one and done. So now you want to review this regularly, either with your partner, if you have a partner, or with a family member or friend. You want to review your situation, your financial situation, on a quarterly or at least an annual basis to make sure that you're both on the same page, or that you really understand where you're at and where you want to go.
Carrie, one more question on this cash flow statement. Someone's asking, where do we see retirement savings on the cash flow statement? So here it's hidden a little bit here.
So retirement savings is actually hidden here in planned savings. But it would be another expense. So even though it's not necessarily, if you're contributing pre-tax dollars, for example, to a retirement plan, it isn't a taxable expense necessarily, but it's an expense nonetheless. And it's not just retirement savings, it's any savings should be part of an expense. So if you, for example, are planning a big family trip in 2 years to celebrate, one child's graduation, for example, that's an expense that you want to start saving for, and you would include it in your expenses. That sort of saving, if you need to, start, I'm saving towards this goal. And retirement is one of the many goals that you might have for your life. All right, so we've talked a little bit about assets and liabilities and income, and I wanted to sort of shift a little bit and talk about company benefits. We're in a period of record low unemployment, and companies are really bending over backwards to try to attract talent. And one way they can do that is with salary, cash. Obviously, everyone loves cash. But companies can often offer more value to employees with benefits due to the tax laws. So basically, they're providing you a benefit that you're not paying tax on. So it's worth more to you. So it's really important to understand what type of benefits your company offers. If it's a larger company, obviously there are going to be more benefits, but every company offers some type of benefits, and delving into the details can really be helpful and extract value. So you want to understand, a lot of companies have an enrollment period, an annual enrollment period, for example, in the fall, October, November timeline, where they ask employees to enroll in certain benefits programs. And there are exceptions to that. If you're a new employee, if you get married during the course of the year or have a child, there'll be an open period for enrollment in benefits. But typically that's the timeline for most companies to enroll in different benefits. And I'm just going to touch on a couple of them here. One is sort of the ability to save for retirement with a 401k plan. So companies often offer you an opportunity to save for retirement with a 401k plan. And a lot of companies offer a match. So they may offer a dollar for dollar match to anything that you contribute to your retirement plan. And that's money that a lot of people leave on the table. If you don't have the cash flow to, put the full amount that the government allows you, and for an individual in 2022, that's $20,500 or $27,000 if you're over the age of 50, you at least should put in enough into that 401k to make sure that you maximize what the company is willing to match. And a lot of people also don't focus on what happens to those assets once they're in the plan. So make sure that you understand your investment options and that you regularly review those options. Another way that companies are offering employees the ability to save and set aside money for healthcare expenses is with health savings accounts and flexible spending accounts. So make sure that you understand what those are and ask your company what type of benefits they may offer. Some companies will actually match health savings account contributions. And the benefit of those types of accounts, both the flexible spending and health savings account, is that you're able to take some of your salary and put it into these accounts without paying tax on those amounts, as long as you use them for healthcare related expenses. So that's a big benefit, particularly as healthcare expenses rise, and for a family, that could be a big portion of your annual expenses. Other things to look at is some companies offer employees the opportunity to be an owner of the company by offering restricted stock grants, options, and the opportunity to participate in employee stock purchase programs. So ask about those benefits and investigate what the options are for you. Group insurance, group life and disability insurance companies offer, usually some companies may offer a baseline free benefit equal to your annual salary. They may offer you opportunities to increase that life insurance or disability insurance. So ask about those benefits. And then benefits beyond that, I mean, there's legal assistance. Some companies offer free legal advice. parking, lunch, public transportation discounts, education reimbursements, student loan payments. So, do the research, figure out what your company offers, and make sure you're really maximizing those benefits. So now we're going to shift to insurance coverage, which is another thing that you want to gather information about. Insurance really is a method for transferring risk to a third party. It's basically a contract where the individual receives financial protection or reimbursement against losses. And there are all types of types of insurance. You're probably familiar with life insurance, which kind of protects a family against premature death. And there are many different types of life insurance. You got to understand what you own and what type of coverage and benefits that type of policy provides. And even if you don't work, there may be a reason why your family should have life insurance on you. If you're the primary caregiver, you know that you don't just do nothing all day. And those, finding somebody to take care of all the tasks, the child care, rearing, the family, household management, et cetera, finding someone to replace all the things that you do each day would be very expensive. So having a life insurance policy to basically replace you is important as well. And, we really, for life insurance, we really see it as replacing income or expenses that would otherwise be earned or incurred by a particular person. There are other ways to use life insurance for investment reasons, but we're not going to talk about that right now. Health insurance protects against catastrophic or unusual medical expenses. And most of us get our health insurance through an employer or a spouse's employer or COBRA. Or in the healthcare marketplace. And then in retirement, most people are going to be looking towards Medicare and supplemental plans to serve this purpose. But understand your healthcare coverage, understand what type of benefits you need, and what type of hoops, what doctors are covered, et cetera, because it can make a really big impact on your financial expenses if you're incurring healthcare costs that you don't need to. Disability insurance. This is another sort of income replacement type coverage, insurance coverage. Disability insurance covers a percentage of your income if you cannot work. And there are different types of disability insurance. There are some that say, we're going to cover you and give you a dollar amount if you can't work at all. And there are policies that say, if you can't work in your industry, we're going to reimburse you for the expenses. So understand what type of coverage you have and the costs associated with it. It's really important. I think you don't think about disability insurance, but you're more likely to be have some sort of a physical impediment to working than you are to actually pass away and not be able to work. So disability insurance is really important. Long-term care insurance protects against a prolonged medical care event and can be very expensive to purchase right now. But there are a lot of reasons to think about it as you near retirement age. And I'm going to quickly, sorry, I've been talking for a long time here, but homeowners insurance is going to protect your damage against your house. But also remember that liability or umbrella insurance is really important because that kind of an umbrella insurance policy sits on top of your homeowners and your auto insurance coverage and provides additional protection against unintentional harm done to another or on your property. And I always say, if you have a young driver, make sure you have umbrella insurance to cover any and all costs that may be associated with an accident. So another big part of gathering information is understanding when and how you last updated your estate plan. And this is an estate plan. People kind of say, oh, it's just a will, what's the worst that can happen? I don't have a will. My estate will go through probate, which is a legal process where your assets are distributed to your heirs and your beneficiaries by the court system. And if you don't have a will, your wishes may not actually be followed. So you really need to make sure your will is been created, it's been signed, and it's up to date. And people create a will all the time. They go to an estate planning attorney, they talk, they get the documents all drafted, and then there are one or two things that hold up the actual signing of the document. And I can tell you, it's typically like picking a guardian for your children. In my case, it was my husband wasn't sure who should pull the plug if I wasn't around. And he was thinking like his sister was just a little too nice and that my sister was not so nice. So maybe he should shift it from one sister to the other. But it led to a delay in us signing our will. And don't let that happen. Pick somebody, sign the will. You can always change a will or modify a will. Particularly with guardians, you know, one guardian may be appropriate at a particular age for your children, and a different guardian may be more appropriate when those children age and they're in high school and have different needs and might be better served with someone else. So you could always change it, revisit it, just get the document signed because you don't want to be left with nothing there. And the other parts of the estate plan that are equally as important are what are called advance directives, which is basically a written document that provides the medical personnel who are helping you with your wishes. So if you can't make decisions on your own behalf, if you're incapacitated, the document basically tells the medical team how you want to be treated. And there are two other documents that go hand in hand with this. One is a healthcare power of attorney, and that gives one of, you know, it could be a family member, it could be a friend, the power to help you make healthcare decisions if you are incapacitated. And the one other thing that people forget in terms of healthcare is the HIPAA. So I'm not going to remember what the acronym stands for, Allison, but HIPAA basically protects your medical information. It creates a privacy policy about your medical information. And where it comes into play is when, for example, you have young adult children who are in college and away from you. And if they have a medical event, technically, because they are over 18, the hospital cannot tell you, a parent or a family member, what's going on with their health situation. And so having a HIPAA form signed and having your child give you access to that healthcare information can be really helpful in helping them through a medical event, particularly if they're incapacitated. And then the final part of a estate plan is a power of attorney. And this is not just the healthcare power of attorney, but a financial power of attorney. So if you're incapacitated or just not feeling up to it, you can basically give somebody else access to make financial decisions for you. So these are important documents for everyone to have, and they need to be up to date. They can't be something that you created, you know, when you got married 20 years ago. You need to revisit it from time to time, and it doesn't have to be, you know, every year, but maybe it's every 5 or 10 years, or when there's a significant life event, and make sure that your estate plan is up to date. And one other thing I'll touch on this is that a lot of people update their estate plan and they agree on these are going to be the beneficiaries, this is where they want the money to go, and they don't actually follow through. So I would encourage each and every one of you to go and look at all your life insurance policies, all your retirement accounts, and see who the beneficiaries are on those accounts, and to make sure that those beneficiaries are the correct beneficiaries. Or the contingent beneficiaries. The contingent beneficiaries are the people who will receive the assets if the primary beneficiary is no longer living. So it's something that should be updated regularly, probably more on an annual basis, looking at your insurance policies, looking at your annuities, looking at your retirement accounts, and making sure that you have beneficiaries designated for those accounts and that they are up to date. And also, I will encourage you to make sure that your parents and your siblings have up-to-date estate plans, because if you are a beneficiary in their estate, you're going to be stuck handling their affairs if something happens to them. So you want to make sure that they have gotten all their ducks in a row and have voiced what they want to happen to their assets if something happens to them. All right, last slide, I promise. So this is something that is in the news a lot, actually, with Ukraine, and people are very worried about cybersecurity and protecting their assets and their families' assets against fraud. So there are a couple things I wanted to touch about here. One is talking about credit history. So everyone in the US has a credit history, which is a record of your repayment of debt obligations. And so what you want to make sure is that you have a positive credit history. And this is really important. People don't think about it, and they may, not be the primary breadwinner. They may not have any credit cards in their name. And if something happens, if there's a divorce or if there's a death of a partner or an unexpected medical illness of a partner, it's really important to have your own personal credit history. And one way that you can build your credit history is to be an authorized user on a spouse's credit card, or you can get what's called a secured credit card, which is kind of like a debit card where you give the credit card company a pile of money, and you're basically spending down that deposit, but using it as a credit card. And it will help you build your credit history. And one way to check your credit history is to do basically an annual credit report. And the federal government, U.S. federal government, requires that the agencies offer each individual a free annual credit check. So you can go to sites such as annual credit. Oh, Allison, you mind putting it in the chat?
It's at the bottom of the slide right there, annualcreditreport.com.
Oh, annualcreditreport.com. And basically what it does is it gives you an output of all of the credit lines that are in your name. And it's really an interesting thing to look at, particularly if you haven't looked at it before, because I can tell you myself, like when I was in my 20s, I would go into J. Crew or Bloomingdale's. I'd be like, oh, sure. They say, you want 20% off today? Oh, okay, I'll open a credit card at J. Crew or Bloomingdale's. And then you just forget about it. You cut up the card, you never use it again. But all of those open credit lines are still on your credit report. So getting a copy of the annual credit report, making sure that the only credit lines that are open are ones that you're using on a day-to-day basis is a good task to do. And it also can be really informative. Some people, when you order your annual credit report, will find credit lines that are mistakenly associated with them. My husband's name is Greg Smith. There are a lot of Greg Smiths. So when we downloaded his annual credit report, we found a lot of credit lines that were attributed to his credit history that were not him. So cleaning up your credit report is something that you should do, if not, probably annually. It doesn't take much time once you clean it up, because hopefully you don't have a lot of credit lines that you need to review. Other things that you can do to kind of address and protect your credit is, there are three agencies now: Experian, Equifax, and TransUnion, that manage credit histories in the US. And you can actually freeze your credit. And what freezing your credit does is it basically keeps anyone from opening a new line of credit in your name. And that can be a really good protection against fraud. You're basically freezing your credit. No one can open up a new credit card in your name. No one can take a loan in your name. And it can really help you improve your credit report, because you're making sure there's no fraudulent activity on your credit history, but it can protect you as well. And the agencies all offer it for free. And, it will keep you from opening a credit line on the spot. But it's really easy actually to open a new credit card, even if your credit is frozen, because you basically get a username and password to each of the credit agencies and a special PIN, and you can unlock your credit history for a period of time. So for example, if you wanted to open up a new credit card company, you ask the credit card company which of the agencies they're going to check your credit on. They tell you, for example, Equifax. You go onto the Equifax website, you unfreeze your credit for 48 hours, and the credit card company is able to check your credit, and then your credit is frozen again. So I think it's a really good task to do, both for yourselves and for your children, so that no one can open a credit line on your children's name. using their social security number. And I mean, there are all sorts of other ways to protect yourself against fraud. Never use public Wi-Fi to access a financial account. And I mean public Wi-Fi, I mean Starbucks, I mean the airport Wi-Fi, I mean a hotel Wi-Fi. If you really need to get into a financial account and you're away from home, you're better off using a hotspot from your phone than using public Wi-Fi, because anyone can get access to your information if they're looking for it, if you're using public Wi-Fi. Also, never send any personal information via email. We see this all of the time. Even we see accountants sending tax returns via email and not protecting them. Tax returns have your social security number in them. Do not allow anyone to send you any information, or don't send any information with account numbers, social security numbers, any personal information that people might be able to use if they hack into your email account. And you know, if your accountant does send you a tax return without protecting it, call them out and say,